Good evening to all of you. Welcome to our class today. And today we shall discuss on business valuation. We shall discuss on business valuation. And this topic is the main purpose or main objective is maybe to be able, or you as the financial analyst, you are the one who is giving financial decisions, okay, financial market decisions. Should the firm, for example, okay, take up maybe an investment, okay, take out maybe acquire company B, acquire company C, buy stock in this particular company. If we have individuals, should they buy bonds in the market? So simply, we're trying to assess what is the true value of, we're trying to determine, okay, what is the true value of a given investment, okay, and should we take it up, okay, what is true value and what is the value that the country in the market, that particular stock, that particular investment, that particular security is going for, okay. So more is, should we buy that stock, should we hold that stock, or should we sell that stock, okay. So at the end of it, you should be able to give the proper advice, okay, as to whether what value, what is the true value, okay, what is the intrinsic value, okay, what is the fundamental value of a given security, okay, or a given company, okay, by the use of different valuation models, okay. So essentially, that's what we're discussing, okay? Valuation of individual securities, okay? Equity shares, preference shares, bonds, okay? Debentures, okay? So try to determine what is the true value of this particular stock, okay? What is the true value of this particular security, okay? And if I was to compare this with the market, okay, currently, how much can I buy the shares of Safaricom, okay? I can buy them for example, that's a 28 shillings, okay? If I'm going to buy them 28 shillings, but what is the true value of the share Safaricom, okay? Assuming that from your different valuation models, okay, you estimate the value to be 26, okay? So you see that for the market has given higher value than the true value of the shares of Safaricom. The true value is 26. The market is giving a value of 28. Therefore, what should you do, okay? Therefore, in case you are looking for an opportunity to invest, you'd rather wait, okay? Because the value is 28, okay? The true value is 26. So the share is simply therefore overvalued, okay? The value, the market value is higher than the true value, than the intrinsic value of that particular share. Therefore, in this case, therefore, if you wanted to buy, for example, you need to just ignore it, okay? You'd rather wait until it goes back to its true value of 26 shillings, okay? So essentially, that's what we discuss this topic, okay? Try to determine what is the true value of the individual securities, okay? As well as valuation of companies, okay? What are the different models? What are the different methods, okay? Within the syllabus, okay? That you can use to assess what ought to be the true value of the company, okay? If company A want to acquire company B, okay? So you may want to answer the question: how much should I be paying to acquire company B? Okay, if you don't acquire controlling interest in company C, okay, how much should you be paying for the 60% ownership stake in company C? Okay, so you have to valuation, you have to determine what ought to be the true value of the company. So it should be in this topic, therefore, we shall be discussing valuation of individual securities and the valuation of companies. That is what we shall be discussing. Of course, the different models, okay, the different models that you can use in business valuation, okay. So why do we need to do to know, well, what are the reasons behind valuation, okay, both for companies as well as for the individual securities, okay. One, of course, the main thing is in case one company is trying to acquire another company, okay, I think I mentioned that already, okay, that we have this company want to acquire company B, okay, they want to buy 40% of company B. But what is the true value of that 40% stake that they want to buy in company B? Okay, should they pay $10? Should they pay $10, $20 million? Should they pay 20? Okay, what is the true value of the 40% stake they want to acquire in a company B? If they want to acquire 100% interest in company B, okay, how much should they be paying to acquire that 100% control interest in company C? Okay, So essentially, you do need to determine the value. You need to, for you as a company who is bidding, you want to buy their company, you want to know how much will be paid for it. You don't want to overpay for sure. Okay? You want to know what will be the true value I shall be receiving if I invest in company C. Okay. The same applies to the shareholder who are selling their company. Okay. Don't get your two parties here, company A or company B. Okay. You have company A as well as you have company B. Okay. Let me just share. Okay. So first here we have company A. Okay. Then you have company B. Okay. This is a company acquiring. This is the acquirer, and of course this is the acquiring. Okay, so of course for company A, what do they want? Okay, they want to know how much should I pay for company B? I want to acquire, for example, 100% controlling interest in company B, but how much cash, for example, whatever way, cash plus stock, for example, okay, if that's the how it is going to be offered. But how much should I be paying for company B? Okay, you want to do the valuation of company B. Okay, determine exactly how much should I be paying for company B. Okay. For company B, the same, of course, the shareholders, don't forget, they are the one who are selling the stake. Okay, so this is the sale of their stake. Okay, so they're selling their company to company A. So they want to determine how much should I sell my company at? Okay, what is my value? Okay, because I don't want. Look, here the main concern is that you overpay. That's the main concern. Okay, you'll be overpaying for a company that maybe its true value is only its true value, for example, is 10 million, but you're not paying, for example. Okay, this is what you pay. Okay, but the true value of the company you've acquired, okay, its true value, let's say 8 million. It means you're paid for a premium. Okay, it means you're paid a premium over and above the true value of company B. So this is the main concern. Okay, that you may end up overpaying. Okay, now for company B, on the other side, okay, the shareholder, okay, they're selling their company to company A. Okay, therefore they want to determine what's our true value. Our true value is 8 million. Therefore, can we get more than 8 million, for example? Okay, of course, they consider this is the lowest you can come. Okay, but we want to, I mean, we need to know our value. Okay, we need to know our value so that as we go to the table for negotiation, as we go to negotiate for a deal. Okay, we know exactly. Okay, should I pay? If the deal is going to be lower than 280 million, then you can say no, for example. Okay, so but you need to value. You need to know what is the true value of the company that we are selling now to. We as company shareholder, what is our true value? Okay, as we dispose of our company, we need to know what is the true value, the exact value of the shares we are selling off to company A, for example. Okay. And also, when deciding to float or sell a company, okay, in the stock market, you generally don't forget, okay, if, for example, a company is fighting for, or the company would want to do an IPO, okay, then of course you need to do valuation of your company, okay, to know that the value that we are offering, to the market is X. Okay, so as you float a share, you can say that you're going to be issuing 30% of the company shares. Okay, so if you're going to be issuing 30% of the company shares, now what is the value of that 30% the company is offering to the market? If the company says that we shall be floating 90% of the company share in the market, now what is the value of that 90% that you want to float to the market? Okay, was actually is the only difference that in point number one and point number two. Point number one is that you have another company buying another company. Okay, so that's an acquisition. Main company in point B. Now the company is floating the same sort of concept, but the company is floating the shares in the market. Okay, but the underlying concept is a sale is being made. Okay, a sale is being made. So definitely, as also you do the shares flotation, you want to know exactly how much value, what's the value of the shares that we shall be floating in the market. If the value of the shares that that percent, if you're going to be floating that percent of the company shares, okay, then and the value of those 30% is equal to 10 million. Every million, therefore, you shall be asking for the market for a bare minimum of 10 million, okay, because it means you'll be selling 30% of your stake to the market, okay, in the case of an IPO, okay. Also, when a company is being liquidated, okay, when a company is being broken down, okay, for example, you can have a scenario where the company would want to say, okay, we're going to sell for one of our branch, okay, we are maybe Africa, okay, we want to sell off our tire making business. But what is the value of your tire making business? You want to set off what's the value of that department in quote, okay? that part of your company. Okay, that means that you need to value that part of the company in itself. Okay, you may not be closing down as an entire company. Okay, you may not be closing down 100% of your operation, but you may be deciding to sell a part of your operation. But what's the value of that part of the operation that you're deciding to sell off to the market? Okay, so that's also mean, therefore, as a company, you may need to know exactly, therefore, what is our value of this particular business? Okay, okay, what's the value of this particular portion of the business, and that warrants that you need to carry out the evaluation of that department, the evaluation of that particular part of your business. Okay. Also, in case where you're going to be using, for example, okay, in case where you will be using maybe your stake, okay, as a collateral, okay, you're going to be using your stake, your shares, okay, as a collateral, okay. You want to take a loan, however, the person providing with the financing ask in exchange, okay, provide me with a collateral, and this time the collateral is not in form of your physical assets, okay. The collateral that you shall be receiving is in form of the shares of the company. That means if in case you're going to acquire a loan of 10 million, then what stake should you offer for the 10 million loan that you're being you are receiving in form of loan from the financier? Okay, so that means therefore, if the loan you've taken is 10 million, then you should be offering, okay, maybe a commensurate, okay, value of the shares, okay, shares worth, for example, 10 million, okay. Because in case you fail to pay, what happens? It means for the financier, okay, in this case, the loan provider, a bank or whatever it is, whoever is providing the loan to you, okay, you'll be become a shareholder of the company. So in case you did add a value your shares, it means you gave more share to the financier. It means you'll be acquiring higher stake in the company than what they have meant to acquire, for example. Okay, so you need to have an idea, okay. Also, in the case of a scheme of merger, okay, just like acquisition, the same has to apply. Okay, if we have two companies, we have NIC and you have CBA coming together. Okay, they want to form a merger, they want to form one corporation. Okay, but of course you need to have you as NIC, what do you bring to the table? Okay, you as CBA, what do you bring to the table? Okay, so you need to be able to, as we merge, we know I am bringing X. You as CBA, what are you bringing? You're bringing Y. Okay, so you can become. It becomes easier to negotiate. Okay, that's in case CBA, the asset worth, your asset worth is 40 billion. Okay, you as NSC, what's your asset worth? Okay, is 30 billion. Once we combine, it means therefore the old shareholder of CBA, you'll be controlling 40 of the 70. Okay, you as the shareholder of NIC. Okay, what was your stake? Okay, your asset was 40 million. Okay. The combined company, what's the total value? It's 30 plus 40, 70. Okay, so you as CBA, you're getting 30 out of 70. Okay, control in the company. You as NSC, what do you get? You get 40 out of the 70. And that's mean for you as you to propose for this merger, then you need to do valuation of the two company to determine exactly how much value do you bring. Okay, you as partner A and you as partner B, for example. Okay. And can already mention this, okay, when the company want to do, for example, an IPO. You need to know, okay, how many shares are you proposing to offer to the market? Okay, you want to offer that percent. What the value of that percent that you're proposing to offer to the market? Okay, so that you do get the money from the market through the issue of shares, through the IPO, the value of those shares. Okay, you don't want to give to the market higher value than what they're paid for example. Okay. Okay, those are some of the reasons why it's worth enough, okay, that as a company, you do need to know exactly, therefore, how much value, okay, what's the value of the company, okay, all the way from case you have acquisition being done, as well as all the way to the case of an IPO, okay, so getting to know exactly how much what's the value of the shares that we would want to offer to the market at the end of the day, okay. Always all clear, okay. Now, when it comes to valuation, okay, there are diverse array of methods that can use, okay, when it comes to valuation of shares, okay, or valuation of companies, okay, the valuation of bonds or debentures or preference shares, okay. There are methods that can use, okay. Let me first concentrate with the valuation of funds or valuation of companies, okay. The first method, okay, that is involved in valuation is called the asset valuation method, okay. The asset valuation method, or the so-called the net asset value method, NAV method, net asset value method. Okay, the first method we can use in valuation of a firm. Okay, Then the other method we shall discuss. We have what we call the income-based valuation. We shall discuss two methods. You have the P ratio, and you have the so-called the earnings yield method. Okay. And lastly, we shall be discussing on the cash flow-based valuation. Okay. In a very summarized way. Okay. So this will be in a very summarized way. Okay. So in future, we should discuss in detail on the cash flow-based valuation. But for now, we shall discuss in a very summarized way. Okay. So let's begin with asset valuation method. Okay, the NAV method, the net asset value method, NAV method. Okay, the net asset value method. Okay, the so-called net asset value. What happens essentially is that we're trying to determine the minimum value. Okay, so if we're trying to estimate what ought to be the minimum value of this particular firm, essentially the value of that firm ought not to go below this value. Okay, so the net asset method, the net asset value method, okay, the net asset value method, okay, give us this minimum possible value of the firm. Okay, that means, therefore, if, for example, you have a scenario where we have two companies, okay, one wanted to acquire the other company, okay, you may want to consider, how much is the acquirer willing to pay? Is it below the NAV? Because if it is, then therefore you have been given a very poor deal, okay? If it is below the NAV, it means you'll be a very poor deal. The company value ought not to go below this particular value. That's so-called the NAV method. Okay? And what's the NAV method? It's simply if we were to dispose of all the assets of the firm, okay, if the company, okay, was to sell every single piece of its assets and use that money to pay off its liabilities, okay. So if the company was to dispose of every single asset, okay, in the market, okay, the assets they own in the market, okay, how much can those assets fetch? Okay, they can fetch, for example, 10 million. Then if you have to use that 10 million to pay off the company liability, both current and non-current, how much money would remain? Okay, if, for example, you're able to fetch 10 million, okay, let me just share my board. Okay, if, for example, the company was to sell its assets, okay, so the amount they shall be fetched for sale assets, okay, assume it to be 10 million, okay, and if their total liabilities, okay, both current and non-current, both current and non-current liability plus current liability, okay, add up to 9 million, okay. Now, the company will need to dispose of the entire asset base, okay, they have 10 million, they use that money to pay off the 9 million worth of liability. So what remains? It remains, in this case, for example, it remains 1 million. So the 1 million is referred to as the net asset value, okay, it's referred to as the NAV, okay. Don't forget, as you can see, we are trying to say that this is the minimum value. So the NAV give us the minimum value, okay, to give us the minimum value. Okay, why? Because this company is, don't forget, we are disposing of, okay, we are trying to realize the company assets, okay, we are disposing of. Then why does it dispose occur? It occurs if the company is closing down. Okay, and of course, at the point of closing down, you're not going to realize it. There's no any chance of being able to realize the future cash flow. There's no in quote future. Okay, so you're only going to be realizing today's value, the market being the market. Okay, and of course, in case you're going to be disposing of the asset, knowing that the company is closing, the company is liquidating, there's no way the market is going to be offering you any future cash from it. There's no future in quote, okay, for the company. So you cannot say that if you are to buy this asset, you can realize the following, you can be able to earn the foreign cash flows. You don't have that opportunity, okay, because you are closed, you are liquidating the company, okay. So it gives us therefore the minimum possible value, the minimum possible value, okay. So the value share of a company, okay, using the NAV is simply equal to the net tangible value of equity, the net tangible value of equity divided by the number of shares. The net tangible value of equity. What is equity? Don't forget, simply equity is assets minus liability. That's what we call equity. Okay. There's simply, therefore, we can say that the NAV, the net asset value, okay, therefore is equal to the net tangible value of equity divided by shares. Okay. If, for example, Let me just take you back. Okay. Don't forget, equity is equal to assets minus liability. Is equal to assets minus liability. Okay, as you can see, therefore, we are trying to say that the NAV, okay, the net asset value is simply the equity. Okay, is the net tangible. Is the net is equal to net tangible value of equity. Sorry, not intangible, but tangible. Not intangible, but tangible. Okay. Okay, tangible value of equity. Now, for example, okay, from calculation, okay, we did get the value, the NAV, okay, we'd get the NAV to be equal to 1 million, for example, in this case, therefore, okay, the 1 million is the total value, okay, the total NAV. This is the total net asset value. If, for example, you don't want to get the value on per share basis, okay, on per share basis, you want to get what is the NAV per share? The NAV per share, okay, will simply equal to the total NAV, the 1 million we have here, we divide by the number of issued shares, okay, the number of shares, equity shares of the company. And that gives, therefore, the NAV per share, if you don't get the NAV per share, okay. So the 1 million, this 1 million is total NAV. This 1 million is total NAV, okay. Because sometimes can be asked, okay, give us or estimate, therefore, what is the net asset value per share. Not actually, sometimes the examiner can ask you, get the minimum value per share, okay? But I think I've seen that question examiner asking you, what is the minimum value per share for this company? We are still being asked to get the NAV per share. That's what being asked, okay? Because sometimes the examiner do ask you to determine the minimum value. You are still being asked to get the NAV, the net asset value, okay? Then here, with something that you may want to take note of, okay, is the tangible assets. Now, don't forget the company may be having what we call the intangible assets, okay? So you can have a scenario where the company has intangible assets, okay? For example, they may be having patents, they may be having some development costs, okay? The R&D, somewhere they have made some investment, they have copyrights, okay? So if the company, there's goodwill, for example, also, okay? Well, all this makes part of the intangible asset company. They are assets, okay? But they are intangibles, okay? Now, if the company is closing down, they'll get net asset value, the company is liquidating, okay? Now, if the company is liquidating, okay, can we go to the market and tell the market, this is our goodwill, okay? Can the market pay for that goodwill, independent of the company? But the market cannot pay for that goodwill independent of the company. The goodwill exists because the company is there. So in case you're closing the company, then the goodwill goes to the company, in short. So those intangible assets, okay, an example being the goodwill, okay, that it is not possible for the company to dispose that goodwill, to dispose that intangible without or independent of the company. That in short, that goodwill is attached to the company, okay. That intangible is attached to the company. That if the company does not exist, then we don't have that particular asset. Okay? And I'm saying the goodwill being one of the classic example. Okay, so in case the company has goodwill, then they move that goodwill. When doing the evaluation, when doing the net asset value method, okay, we need to remove that goodwill. Why? Because it is an intangible. It is not possible for us to be able to fetch that value of goodwill, because the market cannot buy the goodwill independent of the company. You can't go to the market and say, this is my goodwill, buy this goodwill. It's not going to happen. Okay, the goodwill is bought, or the people pay for the goodwill, okay, because the company is still in operation. Okay, when the company is closed down, why do they pay for the goodwill? Okay, so all those intangibles that cannot be independently sold from the company, okay, they are not independent of the company, then we need to exclude them from the analysis. Okay, we need to exclude from the analysis. Okay. So they are excluded in calculation of the net asset figure. Okay, we need to exclude them unless, okay, it is possible for us to sell them in the market. Okay, unless there's a really market for that particular intangible. Like an example. Okay, if we have, for example, patents. Okay, we have patent and copyright. Okay, look, it is possible. You go to the market and tell them, I have a patent for this particular product. Okay, the market is willing to pay for that patent independent of the company. Okay, so the market will pay for it. Because our corporate, okay, for the research, whatever it is, okay, but you have a patent, you have a corporate. It is possible to go to the market and dispose of that patent, that copyright, independent of the company. The market can buy that copyright, can buy that patent, okay. In that case, therefore, the intangible, the parent and the corporates, okay, it is possible to be sold independent of the company. Then when doing the analysis, you ought to include them. Okay? In this case, you ought to include them in your analysis. Okay? Why? Because first of all, it is possible to estimate the market value. At the same time, the market can buy them independent of the company. Okay, in that case, therefore, you can include that. You can include the parents, the corporates, when doing the analysis. Okay, you can include them in the analysis. Okay, for the goodwill, you need to exclude the goodwill. Why it is not possible to go to the market and dispose goodwill as an independent product, as an independent asset. Okay, that's why we need to exclude it in the analysis. Okay. Also, in case the company has done some R&D, research and development, okay, we also need to exclude them in the analysis because the value of those development is about the future. But now we don't have the future, okay? We don't have the future. Unless maybe someone is willing to take up, okay? Unless maybe if it was a research, okay, you're carrying out, okay? Unless we do have the market or the market is willing, okay, to pay or to continue with that research, okay? On future analysis, okay, the market is willing to pay for it, okay? If the market is willing to pay to continue with the research, okay, then also you can include it in the analysis on the market value, not on its book value, but on what the market is willing to offer for it. Okay, hope that's clear. Okay, don't forget the NAV only includes the tangible. Okay, let me repeat it. It only includes the tangible. If we have intangibles, then we ought to exclude them. Okay, if you're intangible, you exclude them unless they do have their own value, their own independent value. Okay, it is possible to sell them off in the market independently. Okay. Essentially, we can assess the NAV, okay, using three bases. Okay, we can get the net asset value using three bases. Okay. The first one is called the so-called the historical cost basis. Okay, the historical cost basis. Okay, and what's historical cost basis? Okay, the historical cost basis, okay, simply implies if we are to go as per the book value. Okay, if we are to go as per the book value, how much can the asset fetch? Okay, if we are to go as per the book values of the company assets, how much can they fetch? Okay, so we're simply going to be using the book value of the company assets. Okay, if it gave me the total book value of company assets minus there. Okay, just take a note of it. Okay, so in case you use the historical cost basis, you have to use the historical. You have to use the historical cost basis. Okay, again we go to the total book value, use the book value, okay, total book value of assets, okay, minus total book value of liability. Okay, so simply it's the book value. So you simply go to the balance sheet of the company, get the sum total of the assets of the company minus the sum total of the company liabilities. Okay, that's the first method. Okay, this is the first basis. Okay, the first basis of getting the NAV, the use of the historical cost basis. Okay. Then you have also another called the replacement cost basis. Okay, the replacement cost basis. Now, how do you get the replacement? Okay, so simply, in the case of the replacement, is the value of the asset is the value of the value, okay, of the assets if the asset to be used on an ongoing basis. Okay, if it be used on an ongoing basis. Okay, let me just explain what that implies. If we are to go to the market, okay, currently, so replacement cost basis. if you go to the market, okay, how much is the market going to be? The easiest way to assess what is the replacement value of the asset is, for example, let me just give an example. Okay, we have a motor vehicle with a life of 10 years. Okay, it has been used for 10 years. Okay, with, I don't know, the following detail. Okay, is it, I don't know, I'm just trying to give an example. Toyota, assume that it's a pickup. Let's see a simple example. Is the company, this is a company asset. It has this motor vehicle with a 10-year, okay, with a life of 10 years, this model, okay. How much can the market, you are the one who want to go to the market and buy a similar, exactly the same asset. How much is the market going to be asking for that asset? Okay. So try to see this. Okay. For the replacement, you want to buy an exact asset, an exact same asset in the market. Okay, so you want to buy an exact same asset in the market. How much is the market going to be selling that asset to you? Okay, in the market, if, for example, okay, the book value of this asset is, let's say $10,000. Okay, the market can sell to you the exact same asset. For example, let's say at $13. Okay, this is what the market is asking. Okay, so the market is asking. And therefore, the replacement value of the asset is $13,000. Okay, that's on the replacement cost basis. Okay, so if the company has, so you need to determine what are the replacement, okay, value of all the company assets. Okay, so it's going to be the replacement value of all the company assets minus the liability. Okay, for the liability, we just use the book values. Okay, so this is going to be replacement value. So replacement value, okay, for the case of assets, we simply minus the book value, okay, book value of liability. So for liability, we just use the book values, okay, for the methods, okay, and that's on the replacement cost basis, okay, that's on the replacement cost basis. Then you have another basis. That last basis is called the realization basis. Realization basis. Now here, how do you get the value of the company? Okay. If you go to the previous example, the one we just done on this asset that this company has, okay. Don't forget you see that the book value was 10 million. However, if the company was to buy the exact same asset in the market is asking for 13,000. Now here, the company is offering this asset to the market. Okay, so the company goes to the market and offers, I have this asset, okay, I have this Toyota Hilux, okay, 10 years, okay, with following specs, okay. Now, how much is the market willing to pay for that asset? Okay, how much is the market willing to pay for that asset? Okay, the market can say, okay, the market can offer. Now, this is the market offering. Okay, so the market can offer, I'll buy it at 11,000. Okay, it implies therefore the market is offering to buy your asset at 10,000. Okay, don't forget, if you're to buy the same exact asset, the market was asking. Okay, the market was asking 13,000. Okay, you can see the difference. Okay. In the case of, therefore, realization basis, it's what is the market, if you to sell this asset in the market, how much is the market willing to pay for it? Okay, how much is the market offering? Okay, so you're going to be using, therefore, the amount you can receive from the disposal of the asset. Okay, how much can you be able to fetch from the disposal of that asset? Okay, so let me just call it the market value. Okay, so going to be for the market value of the company assets minus, okay, we use the book value for liability. Okay, so book value of liabilities. Okay, so the three bases you can use when it's come therefore to assessing the NAV, the net asset value, when you get to the NAV of the company, the net asset value. Okay, so be careful. What is the basis upon which you're using? Okay, is it replacement? Is it realization? Is it the historical cost basis? Okay, because you have different values. Okay, you could end up having different values. Okay, but at the end of the day, okay, the bottom line is that the NAV gives us the minimum possible value of the company. The minimum possible value of the company. Okay, hope that's clear. Okay, so be careful on what is the basis upon which you're using. Okay, the NAV. What basis are we using? Okay, to get the net asset value of the company. Okay, hope that's clear. If you have a question, you let me know. Okay, you see that the NAV, essentially, we can use it to account setting the minimum price. Okay, we can measure that. Okay, and we can agree that this is the minimum value that we can agree. Okay, or the company's value will never go below this amount. Okay, should never go this particular amount. Okay, so the set therefore what should be referred to as the minimum value for the company. Okay, see just simple the what call the takeover value or the floor value. Okay, when I say also, in case you're using the assets, okay, backing for the shares of the company, okay, provide a measure for possible loss if the firm went into liquidation. Okay, so in case, for example, the shareholder are contemplating, okay, disposal of the company, okay, or liquidate the company, okay, then you can give an argument, okay, in case you are the management, okay, that hey, in case you want to liquidate your company, this is the amount you shall be receiving, okay. If you want, if you have to continue with the operation, this is the value of the company, okay. Okay, it's different to make an argument for the company continuation in business. Okay, because in case you have to liquidate the company, then you get a very small value. Okay, if the company was to close down the company. Okay, as opposed to the company selling the company on a going concern basis. Okay, as opposed to the company selling the company on a going concern basis. Okay. The other method, the other way that it can be useful is in a scheme of merger. Okay, and like I mentioned, okay, where you have CPA and NSC coming together. Okay, well, these are similar companies. Okay, the banking sector. Okay, they want to come and form one company. Okay, so you can use them as in comparison to determine. Okay, how much do you bring on the table? Okay, because don't get there's some part of the assets that they can be a bit hard to get their value. For example, one of the intangible. Okay, is the skills of the management of the company. Okay, both company have different set of management. Okay, there's some that have more experienced managers than others. Okay, but now how do you value that? It becomes very hard. Okay, in the case of a merger, don't forget is two company willingly come together to form a single company. Okay, then we can say that those assets can come hard value. Okay, especially in case we are two private company. Okay, we are listed. Okay, now how do you get how the ability to get a value? It's simply tell me what asset you bring. Okay, I bring asset worth X amount of money. Okay, just through an illustration. Okay, just an example. Okay, the case of let's say we have LAC here and you have CBA. Okay, okay, there's some assets that's a bit hard to get the value. Okay, the management. Okay, you have good customer care. How do you get the value? Okay, it becomes very hard. Okay, so the best way, since we are in operation, okay, I determine how much asset do I bring on board. Okay, I bring, for example, 40 billion worth of assets. Okay, so then cash in. Then so CBA, how much asset do you bring on board? Okay, it's easier to get the asset value. Okay, I bring, for example, let's say 30 billion. Okay, at the same time, how much liability? Okay, do you come with? Okay, what's your liability? Okay, for example, liability worth 25 billion. Okay, you as CBA, how much liability do you come with? Okay, I bring liability worth, for example, 20 billion. Okay, therefore, the combined company, we shall be having an asset base of, okay, 70 billion and a combined liability of 25 plus 20, which give us 45 billion. Okay, that implies therefore our combined company is going to have, okay, a value of 25 billion. Okay, a value of 25 billion combined company value. Okay, that implies therefore you here your contribution was 10 billion. Okay, here it was 15 billion. Therefore, you can say therefore the shareholder of NAC. Okay, once we have the NCBA. Okay, once we have combined company NCBA. Okay, therefore the old shareholder. Let me just call the quote shareholders of NAC. Okay, so the old shareholder of NIC, this will be controlling 15 out of 25, okay, of the new company of the NCBA, okay, and the CBA shareholder, this will be controlling, okay, 20, this will be controlling 10 out of 25 of the combined company of the NCBA, okay. That can be an easier way, okay. I'll try to determine therefore how much do you bring on board, okay, and how much do I bring on board, okay, because you don't forget your partner, okay, in same operation, okay, you have a similar risk, okay. So it's this, if the two companies are not in similar business, then this can be a bit hard, okay. The use of NSC might not be the best method to use, okay, in case they are in different business sector. But in case they're in the same business sector, okay, the two of them are banks. The two of them are banks. Okay, then it's a bit easier for you to use the NAV method. Okay, to compare what should be the control interest for the companies combined. Okay, the combined company of the old shareholder of the NIC and the old shareholder of CBA, for example. Okay. Okay. However, of course, this method has its own weaknesses, okay, which I think I've already mentioned. One of them is that the company may be having intangibles, okay? Company may be having intangibles, okay? And the company value is, or the company has the value it has because of those intangibles, okay? If, for example, you have, assume this company is more towards service, okay? It's more a service sector, okay? It's more of a service sector, okay? The company's value, what's the company's value? And because of the excellent service delivery they do make, okay? Now, how do you value, therefore, the value of their service? It becomes very hard, okay? Okay. If, for example, the company is more towards the IT side, okay, where you have more of intangibles, okay, how do you value those intangibles, therefore, okay? If the company is valued because they have good set of management, they have good management, okay, their manager have vast experience, okay, for many years, okay. How do you get the value of those, the value of the skills, the managerial skills that they bring on board? It becomes very hard. Okay. So sometimes you may have cases where some of maybe the investors, okay, they might feel as if, okay, no, this is not the way to go. Okay, we are getting a low deal. Okay, so what do? Okay. Also, this method should not also be used in a case where there's going to be business continuation even after the acquisition, even after maybe the acquisition or the merger. Okay. Because don't forget, this method is just making an assumption that we are closing down the company today. We are liquidating the company. We are realizing the company assets today. Okay. But now, if you're going to continue operation, then why do you need to determine why do you need to determine therefore the value for realization today? You're not selling off the asset. Okay. You simply continue operation. Okay. Therefore, it ignores therefore the future component. It ignores therefore the potential future cash flows that might be earned. Okay. And therefore, some asset has more value, okay, or the value of the asset is more towards the potential cash flow it might bring. When you imply, therefore, as for this value, it has very minimal value, okay. However, as time goes by, the cash flow will be realized. However, don't forget, for this method, we are assuming you are selling off the asset today, their book value today, their replacement value today. So you say that for the future is ignored. Okay. The imply, therefore, if you're going to be making an acquisition, if, for example, the company A want to acquire company B, okay, they're acquiring company B because they want a future, they have a future, or they want a future in company B. Okay, so therefore the future income component of company B is ignored. Okay, if we are to use this method strictly. Okay, so therefore that is some of the weaknesses of this method. Okay. So therefore, we move on to consider, okay, what are the weaknesses of the method, okay? Should we use it in the following scenario, okay? Or is there another better method that we can use if you don't want to estimate, for example, what is the future value of this company, or the value of the company based on the future prospect of the company, okay? And that's why therefore, okay, it's worth enough we try to pursue some other method, okay? Some other valuation method, okay? And one of the methods, okay, the so-called the earnings yield method, or the income-based valuation method, is called the use of the price to earnings ratio method. Okay, the use of price to earning ratio method. Okay, and for this method, okay, is essentially going to be useful if you are attempting, okay, to estimate what ought to be the value of essentially a private company, okay, or a private company. Okay, you're trying to value a private company by the use of public company data. Okay, you're trying, or we are attempting to value a private company through the use of a proxy public listed company. Let me give you an example. In the case of Airtel Kenya, okay, don't forget it's not listed. Okay, however, we have Safaricom that is listed. Okay, so Safaricom definitely and Airtel, they're in similar business operation. Okay, which implies, therefore, it is possible for us to estimate, okay, what ought to be the value of Airtel Kenya by the use of Safaricom data. Why do you want to use the information of Safaricom? Don't forget, at the use of price to earning ratio method, we are going to be using market price. Okay, we have the MPS. For Airtel, as our MPS, it has no market price as per se. Okay, but the shares are not tradable. Okay, with the platform, what we can do is that we estimate what is the PE ratio of Safaricom, what is the price to earn ratio. Okay, the MPS for Safaricom, we have an MPS. At the same time, we have the APS. So we have all the data. Therefore, we can therefore use the data or the price to earn ratio of Safaricom to estimate what ought to be the price of the shares of Airtel if they were to be listed. Okay, this is simply an estimation method. We are simply estimating. Okay, simply an estimation method. Okay, therefore, once we get the P ratio of Safaricom, okay, it will be therefore the P ratio of Safaricom multiplied by earnings per share of Airtel. Okay, I think the best is to explain through my notes here, through my workings here. Okay, so what we can do is that we get the P ratio, okay, of, let me call it Safaricom. So yes, with the market, for example, shares of Safaricom currently, don't get the P ratio, just to repeat the formula, is market price per share, we divide by per share. So simply go to the market, what was the MPS of Safaricom shares at whatever date it is, okay? Assume it was 28 shares. The price on ratio then was, for example, let's say maybe 2, okay? When you apply therefore the price on ratio, in this case, therefore is going to be 14 times. Now, what does P mean, by the way? The P ratio simply means, therefore, for every dollar, for every shilling, okay, of earnings, how much value does the market attach on it? Okay, for every shilling, for every dollar of earnings for that company, how much value does the market attach on it? Okay, of course, they have the value, they have the P ratio, they have the market is appreciating, in quote, the value, appreciating that company's earnings. Okay, so in this case, therefore, we have for every $1 of every 1 shilling of the earnings of Safaricom, the market is attaching a value of 14 shillings. Okay. Now, once you get a P ratio of Safaricom, you want to determine, don't forget, your main objective was to value Airtel. Okay, Airtel. You just go to the books of Airtel, of course, you can get the earnings, because of course they do prepare, they have their own P&L. Okay, therefore, from it, you get the earning per share of Airtel. Okay, because it's easy to get. Okay, so you're earning per share of Airtel. Okay, for example, assume that it is equal to, for example, let's say 3. That's an assumption. Okay, so once you have therefore the price earning ratio of Airtel, you can see therefore the implied MPS of Airtel. So this is just implied. Okay, ought to be equal to its earning per share. We multiply by price to earning ratio. Okay, of, don't forget, you're going to use Safaricom. Okay, or you can use the industry. Okay. Safaricom, we can also use the industry. Okay, if be equal to the earning per share of Airtel. Okay, this is Airtel. Earning per share of Airtel will be equal to right here equal 3 times therefore the P ratio of the proxy company. In this case, the Safaricom, which was 14. Therefore, the value we estimate for Airtel per share ought to be equal to 42. Okay. Therefore, this is simply an estimation. Okay, simply trying to estimate what ought to be the value of the shares of Airtel by the use of the P ratio of a proxy company. Okay, a proxy company. In this case, therefore, it is a P ratio of Safaricom multiplied by the earnings per share of Airtel. Okay. Don't forget, for the proxy company, they need to be in similar industry. Okay, they have similar operation, they have similar financial and business risk. Okay, they should be like that. Okay, Safaricom, of course, and Airtel, they are more or less in the same industry with similar business risk. Okay, they're in the same industry. Okay, if possible, okay, if you want to go in detail, okay, which of course we don't need to do for now. Okay, you may also want to estimate therefore what ought to be their financial risk. Okay, and if they have any financial risk, then of course make adjustment for it. Okay, also make adjustment for it. Also in terms of size, okay, you can also use in terms of size. Okay, is Safaricom in terms of its asset base? Okay, is NAV? Okay, is it greater than Airtel? If it is, therefore, for the P ratio for Airtel should be lower. Okay, If, for example, Safaricom is going to be to have its size is bigger than the size of Airtel, so you may want to discount therefore the P ratio of Safaricom. Okay, you need to discount downwards. Okay, not necessarily, but sometimes in advanced valuation, we discount the P ratio downwards. Okay, if you want to, if you are trying to value either a small company, you're trying to value a private company, because don't forget the shares of public company they're more liquid, okay, compared to shares of private company. Okay, because the shares of private company are less liquid, and if their value is lower. Okay, that's why you need to discount the P ratio downward. Okay, but essentially you don't do this for your level. We don't need to do this for now. Okay. And that's the use of the price to earnings ratio. Okay, that's the use of the PE ratio. The use of P to E ratio. Okay. Question? Okay. Great. That's all is clear. The next method. Okay. So this was method 1. Okay. So that's method 1. So method 2. Method 2. And usually there was the earnings yield method. Okay. The earnings yield method. Now the earnings yield method is simply earnings yield is actually the reciprocal of the price to earnings ratio. Okay, earnings yield, as you can see, okay, from here, is simply the reciprocal of the price to earnings ratio. Don't forget, you say that P ratio is remaining is equal to MPS. We divide by the earnings per share. The earnings yield, okay, is simply earnings per share. We divide by MPS. Okay, don't forget earnings yield is simply the reciprocal. Okay, it's simply the reciprocal of the PE ratio. Okay, so all the limitation of the PE ratio and the limitation of also the limitation, okay, of the earnings yield method is the same interpretation. Okay. So in case therefore you'd want to get the market value, then how do you get the market value? Okay, so simply make therefore the MPS the subject of the equation. Okay. Yes, let's go back to my board. Okay. Okay, we are trying to attempt to get the market value. You see the earnings yield, okay, as mentioned, is given us the earnings of the company. Either can be per share or total earnings. Okay, can be total earnings of the company or earnings per share if it's on per share basis. We divide by the market value. We divide by the market value or the market value per share. So I guess you want to get the market value or the MPS. We see we make the MPS the subject of the equation. Where the MPS or the market value to be equal to earnings of the company. We divide by the earnings yield. Okay, the market value company. We don't get what I've just done and simply made the market value the subject of the formula. Okay, the subject of the formula. Therefore, the market value of the company is its earnings. We divide by the earnings yield. As I mentioned, the earnings yield is simply the reciprocal of the price to earnings ratio, because the price to earnings ratio, okay, is equal to MPS. We divide by earnings per share. Okay, I hope you can see it clearly. Okay, so simply the reciprocal. Okay. This is the MPS we have here, okay, and this is the earnings we have here as the denominator for the P to E ratio, the price to earnings ratio method. Okay. Now, what if now we have the earnings growing? Okay, what if now we have earnings growing? Because what you're doing here actually is that we assume the earnings of the company remain constant. Okay, the company earnings remains constant. Okay, into the future. Okay, they do not grow. Okay. Now, therefore, if there's growth in earnings, actually, if you recall, okay, let me actually, yeah, we were discussing on the dividend valuation model, which I mentioned right now, okay, model under the cost of equity. We say that P naught, we say the market value P naught is equal to D naught 1 plus G. We divide by RE minus G, okay, and from it we say the cost of equity, okay, was equal to D naught 1 plus G divided by P naught plus G. I hope you still know this formula. Okay. Okay, from it, okay, from it, you can also be able to derive that. Look at here, it was dividend, and the dividend of the company, okay, they were, in the case of not growth, okay, let's use the case of no growth, just to recall that if there's no growth, then the market value of the share of the company, P naught, was equal to D divided by RE, okay, oops, remember that formula, okay. Exactly the same thing is happening here, okay, but we're assuming the earnings of the company are not growing. Thus, we get the market value, P naught, okay, the market value of the company is earnings of the company divided by earnings yield, like the dividend divided by the cost of equity. What if now there's the growth, therefore? If by interpolation, we can say, therefore, if this was a formula with no growth, what with the case of growth? This is how we did it. Okay, which means, therefore, we can also apply by interpolation the same formula and say that the market value of the company, P naught, is equal to earnings. We divide by the earnings yield. If there's growth, therefore, we need to factor in this element here. So 1 plus G. In the denominator, minus G. You have it here, minus G. So minus growth. Therefore, therefore, if there's growth in the earnings of the company, here is the case there's no growth in the company earnings. Okay. If there's growth in earnings of the company, therefore the market value of the company will be the earnings 1 plus G, where G here, be careful, is a growth in the earnings. Here G, this G here, was a growth in the dividend. Okay. Now here, this G is a growth in dividend, where G is annual earnings growth. Annual earnings growth. Okay, and of course EY is earnings yield. EY is earnings yield. With earnings yield, and P naught is estimated market value, company's value, firm's value. Okay, and E, just to make it a mention, is equal to the company current earning, current annual earnings, current earnings. So what that? And that's how we get the market value of a company through the use of the earnings yield method. Okay, through the use of the earnings yield method. Okay, hope it's really clear to all of you. Okay, so be careful because sometimes you can have the 2G. Okay, the growth in the earnings, we just highlighted the growth in the earnings. You can have here the growth here. You can have this G, and at the same time you can also begin the same G, the growth in the dividend in the same question. So be careful. There's a growth in the earnings. If you want to use earnings yield method, and this is going the growth in the dividend, you're using the dividend valuation model. Okay. Clear? Question? Okay. If there's no question, go back to our notes. Okay, that's the use of the earnings yield method. The use of the earnings yield method. The next classification of the method is the cash flow based valuation, the so-called the cash flow based valuation. And the first model is the so-called the dividend valuation model, okay, which I think you have discussed time and again, okay, you discussed time and again, okay, the use of the dividend valuation model. Well, just repeat, okay, for those who may have forgotten, let's repeat and just go back to workings, okay, on the use of the dividend valuation model. We see that the market value of the company, the market value can be a company, can be share, okay, is equal to the D. We divide by the cost of equity, okay. So P naught, the market value, okay, where P naught. If there's growth, this is in case of no growth in dividend, okay. So here, case of, so put here on top. Case of no dividend growth, Okay, so second case here is case of dividend growth. Okay, just repeat. Okay, we did say that in case the growth in dividends, the P naught is equal to D naught, okay, 1 plus G, I divide by cost of equity minus G, okay, P naught is equal to X dividend, share price, D naught is most recent paid dividend, but be careful here. Don't forget, in case the company shares are trading, if the company shares are trading come dividend, okay, then that dividend, even if it's not yet paid, okay, is D naught. Okay, if the company share are trading come dividend, then that potential dividend paid in the next 2 weeks, in the next 1 week, is D naught. Okay, even though it will be paid in the future. RE, we can mention is cost of equity, and cost G is annual growth in dividend, annual dividend growth, dividend growth. Okay. And that's the case, the dividend evolution model. Okay, and since we already discussed it, I think it's pretty familiar to all of us. Okay, because we have done it, and the cost of capital topic. Okay, so I think it's pretty easy for us to have a point of reference to it. Okay. Here, okay, that's on the valuation of equity. Okay, valuation of equity by the use of the dividend valuation model. Okay, we can also do valuation, okay, of preference share. Okay, valuation of preference share. Valuation of preference share. Preference share. We see based simply by acceleration be based on the dividend evolution model, okay, where the potential return that the holder shall be getting in the case of preference share, if they are irredeemable, let's make a note here, if they are irredeemable, that's the common assumption we make, then P naught, that is the market value of the preference share, will be equal to the preferred dividend. Okay, let me put P there. Preferred dividend, we divide by the cost of the preference shares of the cost of those preference shares. Okay, so simply therefore the market value of the preference share will be the dividend. We divide by the market, divide the cost of those preference shares. Okay, simple as that. In case you're doing the valuation, okay, that's the case of valuation of preference share. If we are valuing bonds, okay, which I think already done, but just to refresh your mind, okay, valuation of bonds valuation, okay, and assume that let's begin the first one, begin the A, bonds that are irredeemable, then we see the P naught is going to be equal to the interest we received, log to be net interest, we divide by the cost of those those bonds. Okay, so interest net, the cost, the net interest income, we divide by RD. Okay, if you're in the case of bonds that are redeemable, that imply therefore they have an end life. Okay, that imply therefore the holder over and above getting the interest, they also get redemption value. Therefore, P naught will be equal to, okay, the interest we received, okay, net interest we received times present value earned factor. So remember N years. I know this is very familiar to you. Okay, so that's why I'm just trying to get through. So because we've done this already together, and the cost of capital, N years R percent, log this RD because of debt now, okay, plus and the present value of redemption value times present value interest factor, okay, N years, okay, at R percent RD, okay. in case this bond are redeemable. In case of C, if they are convertible, if those bonds are convertible, okay, then the market value P naught should be equal to interest to be received, net interest of course, okay, multiply by present value and factor, n years, the life of those convertible bonds, the number of years to the number of period to conversion, okay, cost of that convertible bonds, okay, plus so get here it's either conversion or redemption, either of the two, okay, because as a holder you have the two options: should I convert or should I redeem the bond, okay, based on the investor rationality. So present value interest factor, n years R%, okay, like they have given therefore the market value of those convertible bonds, okay, and that's our topic on valuation of both company and valuation of securities, okay, both equity, preferred shares, bonds that are convertible, bonds that are irredeemable, and the bonds that are redeemable, okay. That's how we carry out the evaluation of firms and valuation of individual securities. And simply that's Mark 0 the topic. Question? Let me share my question bank, but I'm hoping that you also have one. And go through these questions. Okay, the first question. Okay, page 1, question 1. Okay, so go through it in the next 2 minutes, then we attempt together. Question 1, page 1. Okay, I presuppose that you have gone through the question and you've seen what the examiner was requiring of those students then. Okay, so in this case, you've been asked to get the company's value, okay, using the P/E ratio method and the use of the dividend growth model, okay, the price to earning ratio method, okay. So of course, the first thing, if you want to use the P ratio method, is to get the P ratio, okay, of course, is to get the PE. In this case, the PE is given to us, okay, of 10 times, okay, so this company, therefore, should be using 10 times. Don't forget, by the way, you have to be careful just in case there's a note to it, okay, whether we know to discount the P ratio, we need to reduce it or not, okay. This question, it is silent, okay, so therefore we use the P ratio given to us 10 times, okay. So let me go back to my board here, okay, so the use of the P ratio, okay, so the P ratio method. They're given us MPS, we develop earnings per share, therefore the market value of the company or the MPS is equal to P ratio and multiplied by earnings per share, okay. So this is Danauka company, okay. We'll be told that P ratio is 10 times, that implies therefore, look at here, you can also use the total earnings, to be equal to, we will apply by the total earnings of this company. Let me go back to the question to get the total earnings of this company. Okay, so the earnings of the company, you be told that this is 40 cents. Okay, there's the earnings per share, and this company has 5 million shares. Okay, that implies therefore the total earnings is 40 cents times 5. Okay, 40 cents times 5, because 40 cents is per share. Okay, therefore, if this company has 5 million issued shares, therefore the total earnings is 5 times 40 million. Okay, the total earnings of the company therefore is equal to 0.4 times 5 million shares. Give us how much? With the company's value by the use of the price to earning ratio method. And you get a value of 20 million. Okay, we get the company's value to be 20 million. Okay, quite easy, as you can see, quite easy and straightforward. Okay, that's the use of the price to earnings ratio method. 20 million from capital, thank you. Okay, so you get 20 million to the company's value, you have to use the price to earnings ratio method. Okay, then next we need to use to get the dividend valuation model. Okay, we need to use the dividend valuation model. Okay, P naught is equal to D naught 1 plus G divided by RA minus G. So you need to get these variables. Okay, so let's go back to the question. Okay, get those variables. You'll be told here, just erase these old ones. So you'll be told that the company, the proposed payout ratio. Okay, so this company ordinary shares ex dividend. Okay, don't know about that. The dividend per share of this company is equal to 20 per share 1 year ago is 23 cents. 2 years ago was 22 cents. Okay, and the company is proposing. Okay, the company is proposing to pay 40% of its earnings, 60% of its earnings. Okay, the company is proposed to pay 60% of its earnings. These are the company earnings. Okay, 40 cents. Therefore, see, don't forget the shares of this company are ex-dividend, which implies therefore the proposed dividend is D1. Okay, I hope that's clear. Okay, the proposed dividend is D1. The proposed dividend is D1. Why? Because the shares of the company are ex-dividend. If they were come dividend, then this proposed payout or this dividend become D naught. Okay, so be careful with the terms that are being used here. Okay, so the dividend proposed is D1. Therefore, you can get D1 what to be equal to the company. So D1, okay, be equal to the payout is 6% and the earnings are 40 cents. Okay, and let's give therefore 0.24 of a dollar. Okay, to be the company proposed dividend, which is D1, not D naught. Okay, so we have first we have the D1, D naught. We need to get the G. Okay, so next we get the G, the growth in the dividend. The growth in the dividend. Go to the question. Okay, so growth in dividend. The earnings, the dividend 1 year ago was 23. 2 years ago, 2 years before that was 1 year before that was 22. I think from there we can get the G. Okay, we have the growth will be 20, an increase from 22 to 23.3. Therefore, see the G, the growth in dividend, okay, will be equal to D. Let's see that D. Which is the formula should be 23.3. We divide by 22. Okay, just 1 year because the difference on 1 year. So minus 1 in percent. What do you get? Because it's on 1 year difference. You get how much with the growth and dividend? And get growth in dividend equal to 5.9. Don't round off as much as possible. Try to use exact figures. So get 5.9%, 5.9% of the growth in the dividend. Okay. So you have done that. So we have the G. So you need to get the cost of equity. Let's go back. We see that we can get the cost of equity. Okay. So cost of equity 9.1. That's really better. So 9.1. So thank you. Okay. So let's try to get the cost of equity. Okay. This is Mahir. Mahir, you have a question? Yes, Mahir. Yes, Mahir.
I have a class number. So I was asking,
yes.
In this calculation of D1, we
D1,
use
yes.
the dividend D1 proposed
yes.
payout ratio 60%,
yes.
and times 0.4 of EPS.
Yes.
Aren't we supposed to use the retention so it will be 40%? Or
oh, I meant to use the retention. Oh, okay. Okay, let me clarify on that. Okay, let me just clarify. Look at here, the company, okay, so the company is proposing to pay 60%. Okay, the company is proposing to pay 60%. Don't forget, the company is paying. Okay, the company is paying. So the 40%, just highlight, this is what the company is paying, and it's paying the dividend. The 40% is what is retaining. In our formula, we want to get the dividend, and the company is paying the 60, not 40. The company, this is payout, not retention. but payout ratio. So Mahira, yeah, but okay, the 60% is payout, not retention.
Okay, sir.
Okay, thank you. Okay.
Okay, thank you, sir.
You're welcome. Okay, so having done that, we have our D1. Okay, we have the G. Then we need to get the cost of equity. So the next B, therefore, is get the cost of equity. Let's get started. We can use two models. Okay, you can use this model. Okay, which I think we are not going to use, but you can also use the capital as a price model. You see, it's given us risk-free plus equity beta. Okay, equity beta, return on the market portfolio, risk-free return minus risk-free rate of return. So let's go and check for those variables in our question. Okay. So we have been told that risk-free is 4%, return on the market 10.6, the equity beta 1.4. I think you have all the variables that require. Okay. So the equity beta 1.4 and 4.6. So let's go back to, we apply the model. Therefore, the cost of equity will equal to 4.6, equity beta 1.4, return on the market portfolio 10.6 minus risk-free 4.6. To give us a cost of equity, how much? To give us a cost of equity equal to 13%, equal to 13%. Thank you. 13%. Okay. And then you have all the variables. You have the dividend, you have the cost of equity, and you have the G. Okay. Therefore, the market value of the company by the use of the dividend valuation model is D1 0.24. Don't get here, use the total because we want to get the total value of the company. Okay. 0.24 multiplied by the number of shares, because this is per share, this is DPS. And the total dividend is the DPS times the number of shares. Okay, so we want to multiply by the total share issued of this company, which one? 5 million. That gives us the total dividend, proposed dividend. We divide by this. We don't forget this is D1. Therefore, we don't apply 1 plus G. Okay, because this is D1. We do a cost of equity 0.13 minus the G, which is 0.0591. And you get how much be the company's value by the use of the dividend valuation model. Take note here, don't grow it because this is D1. No, this is D1. You get how much be the okay, and we get 16.9. We get 16.925 $246. Okay, that's be the company's value in case it use a dividend valuation model. It use a dividend valuation model. Okay. Clear? Okay, let's go to the question. Okay, I think the question was a bit expansive. You ask something else. Sorry. Being asked to discuss the significance to focus company of the values you calculated in comparison to the current market value of the company. So we need to get the current market value of the company, because I think that is not given to us. So we need to get what is the company market value. Sorry, the company current market value simply being asked to get the market cap. Okay, being asked to get the market capitalization. Okay, the market capitalization. The company share, the number of shares is 5 million, and the market value per share is 3.3. Which means therefore, the company market cap is 5 million times 3.3. So let's go back. We get a company market cap. Then of course we make an argument. Okay. The company market capitalization. The company market capitalization. There is the number of shares. Equity shares issued. We multiply by the market price per share. In this case, the number of shares is 5 million times 3.3 to give us how much? The company market value or market cap. Give us a market cap of 16.5, market cap of 16.5 million. Okay. Therefore, in this case, you are simply meant therefore to make an argument. Okay, why are the values different? If we were to use the dividend valuation model, that's what we get. If we were to use the the earnings yield method, this is what we get. Okay, why do we have those different values? Okay, well, the significance. Okay, don't forget here, if you have to use the duration model, we say that essentially this indicates therefore the company true value. So this is the true value, the intrinsic value. Okay, this is what the market is giving of 16.5. Now, what does it imply therefore? It implies therefore that the market is giving a lot of value than the company's true value. And with the shares of the company, as per the dividend valuation model, are undervalued. Okay, because the market, this is what it is giving. Okay, however, the true value as per the dividend valuation model is 16.9 million. I mean, the market is giving a lower value than the market value. Okay, the market is giving lower value than the market value. Okay, then what else? If you to make a comparison, okay, through the use of the earnings yield method, okay, through the use of the earnings yield method, okay, we got a value of 20 million, okay, value 20 million, okay. Don't forget here, we are estimating if the company was to be operating like the other its peers, okay, compared to its peers, its peer company. Don't forget this P ratio is not P ratio of the company, it's the P ratio of the average. If I remember, let's just go back to the question. This P ratio we used was average sector. Okay, here it is, was average sector. Okay, that if the company was to be just like the other firms they are in competition with, okay, they have similar operation with, okay, its P ratio is meant to be 10. Okay, its P ratio is meant to be 10. Okay, however, don't forget it is not equal to 10. It means the P ratio of this company is lower. The market is giving a lower value than its value. The market is giving a lower value for the earnings of this company. Okay, it's giving lower value the earnings of this company. Which implies therefore, at the end of the day, since we have used the P ratio of the P ratio of the industry, okay, 10, I mean, if you're going to end up having a case where you're going to end up with a different value together, okay? So if the company of this 20 million, what does it indicate? It indicates if the company was to be at par, okay, with its peers, that its value ought to be equal to $20 million. Okay, that's what we meant to discuss the discussion bit of it. Okay, clear? Question? Okay, that essentially is what you're meant to have done in that particular part of the question. Okay, that particular part of the question. Okay, if there's no question, then I guess we can take a break, then come back. We attempt some few more questions. Okay, we attempt some few more questions. Okay, try to pinpoint those questions. Okay, during the break time, try to go through this question. Once we come back, we're able to go exactly, tell me there's a question, then we have it a bit easier, okay, to do more question once we already know what question you'll be looking for. Okay, so go through the question bank, try to pinpoint those questions. Then once we come back, we shall discuss those questions. Okay, so Mahir.
Yes, sir.
We can take a break, isn't it?
Yeah, we can take till 7:25.
Okay, so
15 minutes.
7:25. Okay, then we meet at 7:25. Thank you.
Sir. Welcome.
Okay, welcome back for a second session. Okay, so let's look for one or two more questions from your examiner. Okay. Okay, maybe a very simple question. Okay, and this page 4, page 5 on THP company. Page 4, page 5 on THP company. Okay, let's go through part A. Okay, page 4, page 5. We go through part A. So take 1 minute. We go through it. Page 5, page 4, page 5, page 6. THP company part A. I suppose that you've gone through the question. What is you've been asked to get the current market value, okay, the current exterior share price of THP company, and the market cap if you to use a dividend valuation model. Okay, don't get as per the dividend valuation model. We need the dividend, Okay, so here the company has a payout of 50, and per share is 64. Then from there you can get therefore half of the earnings of the company are paid as dividend. We need to get the growth in the dividend, which we told is 5%. We told also to get we need, as for the model, we also need to get the cost equity, which is given to us. Okay, and that's make it easy for us. So let's go back to our workings. Okay, so as per the dividend valuation model, okay, P naught is equal to D naught 1 plus G. We divide by cost of equity minus G. D naught, we need to get the D naught. They pay half, and the earnings of the company was 64 cents. Therefore, let's give therefore that 2 cents to be our D naught. The G given to us is 5%. Cost of equity is 12%. Simply, therefore, we can therefore get P naught. Therefore, it will be D naught 0.32. We multiply by the growth in earnings 1 plus G, 1 plus 0.05. We divide cost of equity 12% minus 0.05, and that therefore will give therefore the market value per share if we use a dividend valuation model. It gives us how much with the market value per share? Eight point 7.5 gets 7.5 times. We get 7.5 times with the P ratio of THP. Don't forget here, we assume that CRX company, don't forget, there's no mention regarding whether we need to discount this ratio. So we assume that the two of them have the same ratio. Therefore, assume there's an assumption you're making, okay? The P ratio, you're getting the P ratio of THP company in getting what ought to be the market price of the CRX company. Therefore, in market price is for CRX company will be equal to the P ratio we just calculated. We multiply by earnings per share of CRX. P ratio we are 7.5. We multiply by the earnings per share of the total earnings of CRX. Let's just check it out. Okay, the CRX earnings. Yes, it is. Okay, CRX at the time of acquisition had an earning of 44.8 share, 44.8. Okay, and per share of CRX before acquisition was 44.8. Okay, and the question part C is asking us to get use the P ratio, the share price. Okay, so is the share price. Okay, share price and the market cap. Okay, so here simply multiplying. Okay, so 44.8. So multiply by 44.8. 0.448, and that's give therefore what is our estimated price per share of CRX, which is how much? To give us 3.36 confirm, yes, $3.36 to be therefore our estimated market price per share of CRX. Therefore, the market cap of CRX will be equal to the share price 3.36. We multiply by the number of shares of CRX company before the acquisition. So let's go over the question. We see how many shares does CRX has. CRX. Okay. So if the purchase price, so this time of 1 million issued shares of CRX, there was CRX had 1 million issued shares. So simply multiply 1 million. Okay. Therefore, we multiply by 1 million. So multiply by 1 million. So times 1 million to give therefore the market cap of CRX 3.36 million. 3.36 million. Okay. We therefore the market value, the market cap of CRX company. Clear? Okay. That is part C. That is part C. Part D. Okay, so take a minute to go through part D. Part D. Okay, so here in part D, you have to be careful because here we are making an assumption that the company, okay, is, or rather, the market, okay, is going to be semi-strong, form efficient. I hope that you've gone through this topic, okay. Don't forget, I told you that you're the one who's going to go through this topic, okay. I hope you've done that. If you have not done that, this topic is, I think only 4 pages in the textbook. So take, I don't know, it's going to want to take not more than an hour or 2 hours, okay. So ensure that you have done it in case you have not done it. Okay? So I'm assuming that you have done it already. Okay? That's why I want us to attempt part D. Now here, assume that a semi-strong, form efficient cap market exists. Calculate and comment on the post-acquisition market cap of the company in the following circumstances. Okay, don't forget just to highlight. If we make an assumption that we are in semi-strong form efficient capital market, what does that imply therefore? It implies therefore that the share price shall be reflecting all the current, or shall be reflecting all the past information as well as the current public information. Okay, that's what the semi-strong form efficient capital market imply. That the share price of the company shall be reflecting all the past information of the company, the dividend of the company, the core, so everything about the company past. Okay, as well as shall be reflecting the current public information. That is the semi-strong capital market efficient. Okay. Now in Roman 1, what is the company's value? What would be the T3 company? No, this is post-acquisition. This is post-acquisition. That is after the acquisition. If we are to assume that the company does not make the announcement, which implies therefore this is not public information. Okay. If the company does not make the announcement, then that's not public information. It is in quote private information. And since the market is semi-strong, then the market shall not reflect that impact. Okay. If the company makes the announcement, then this is public information. When implied, therefore, the company's value shall increase in line with the value of the new information. Okay. So number 1, the company does not make the announcement. So therefore, the value of the potential value of the investment will not be reflected in the shares of the company. Okay. Now, I think this question you've done it in the past. We have done part B in the past. Anyway, let's just repeat, but we have done part B in the past because B and D, we're going to use them later on. Okay, in this part, you're going to be using them. Okay, so B and D, we should use them. And in part 4, the company's value of THP, okay, this is the company value of THP company, okay, the market cap of THP company. Now, the THP company, because here we do need to assess the impact of the right issue share. Let me just repeat it. So it becomes easy for us to do part D. The company value of T3 company, so I want to go through B so I can answer D. Assuming that the right issue takes place, ignoring the proposed use of funds, calculate the following. So the right issue takes place, okay? So if that happens, then we do need to know how much cash does, so before the acquisition, what's the value of THP? Before the acquisition, the value of THP, have we just done it? Yes, I think we've done it. We have done it in part A. Okay, so before the acquisition, the value of THP from part A was equal to, I think we just done it right now. Before the acquisition, the value of THP was equal to 14.4. Yes, it is 14.4. Okay, after the acquisition, so here, this is part D. Okay, so market cap, THP company after acquisition, THP company after acquisition. And before the acquisition, the THP company had a value of 14.4 million. Then they have acquired CRX company. They've acquired CRX company. And CRX company, we have it here. The value is here. Okay. So THP, let's give us 3.36 million. Okay. Now, THP company after the acquisition. So before the acquisition, THP company, no, sorry. THP company, we have 14.4 was the acquisition, was the value of THP company before the acquisition. Then the company has issued shares. Okay, the company has issued shares, and the shares the company has issued, this company, they want to acquire, the issued shares, the company won't raise money by TP through what is this? The question now, page 5. Yes, it is. So the company, they want to raise money through a 143, a 20% discount. Okay. They shall incur a cost of 320 in the issue. See, let's look at issue. Let's issue cost of 320. Okay. So less 320. So the company will incur a cost as the issue. They will incur a cost. Okay. So they want to issue. So the issue price. Sorry. Issue. Where is here it is. Okay. So they're going to issue. So let me say cash raised will be equal to offer price, and the offer price is 80% times 4.8. We multiply by the number of shares the company want to issue. The number of shares, let me just go to the question to understand how many shares this company want to issue. It's a 143. The cash base is a 143, and THP company, it's a 143. 143, here it is, 143. And THP company has how many shares? It has 3 million shares. If you're done with this, it has 3 million issued shares. It has 3 million issued shares. So if it's a 143, the number of shares to be issued is a third of 3 million to give us 1 million. Okay, give us 1 million. So we multiply by 1 million times 1 million shares. It gives us how much? 3 point how many million? Give us 3.84 million. If the amount of cash to be received by THP company is equal to 14 is 3.84. Don't forget the THP company already it has a value of 14.4. Then they go ahead and issue shares worth 3.84. Don't forget this is increasing their value. Okay. What does they do? Have they done? They have incurred some costs. In order to raise the 3.84 million, they incurred a cost of 320 million, I guess. They incurred a cost of 320,000. The cost they've incurred, their value is reducing by the cost. This is the 320,000. So minus 320,000. So minus 320,000. There was a value of THP company just before we include the value of CRX. Okay, don't forget THP is the acquirer. Okay, what was their value before acquiring THP company, the CRX company? Give us 17.92 million. Okay, give us 17.92 million. So this is the THP company value. Okay, before acquiring THP CRX company. Okay, this is before acquisition. Okay, let's say this is before pre-acquisition. This is the company's value pre-acquisition. Now, what's the THP company post-acquisition? That's the question that's been asked here. Post-acquisition, ignoring the use of funds. Okay, not ignoring, assuming that this announcement is not made. Okay, now the THP company value before the pre-acquisition you just obtained is 17.92. Then they go ahead and acquires CRX company. They go ahead and acquire CRX company. Okay, now the question is that what's the value of CRX company? Okay, what's the value of CRX company? The value of CRX company pre-acquisition, we have it here. This is the value of CRX company pre-acquisition, so 3.6 million, 3.36 million. So this is a THP company pre-acquisition plus 3.36 million. Okay, so value of THP company, okay, before acquisition, which was 17.92 million, plus the value, okay, of the company that they're acquiring, which is 3.36 million. Okay, clear there? To give us a true value, how much? To give us a total value of 21.28 million, 21.28 million. Okay, 21.28 million. Then don't forget, this is the combined, okay, look at what is the company value before or the company value after. So it is CRTHP and CRS combined. However, don't forget THP has paid money to acquire CRX. So they got 3.36 million, true, but how much money did they pay to get CRS company? How much money did they pay to get CRS company? Is it clear? Don't forget the THP company value, this was value before the acquisition. This is CRS company value after the acquisition. But for the company, the THP company, to get this value from CRX, they have paid money. How much have they paid? Eh? CRX THP company is acquiring CRX. For THP to acquire CRX, they have paid money. Now, how much money did they pay to acquire CRX? That's the question I'm asking. Is the question clear? Or am I talking to myself? What is happening? Yes, back to my head. Don't forget, they are paying 3.84 million. Don't forget, they're paying 3.84 million. So that's money. That was money out. Okay, they're paying 3.84 million. Okay, to get a CRS company. Okay, 3.4 million. However, okay, don't forget, out of 3.4 million, 320 was cost that they paid, was the issue cost. So as per se, it doesn't add value as per se. Okay, as per se, it doesn't add value. If anything, the 20,000 that we have is taken care of here, if you remember. So we have already subtracted the value, okay, with minus 320. Therefore, the true value of the company post acquisition is going to be 21.8 million minus what they paid net of the issue cost. Okay, because the 20 is taken care of in this value here, so we cannot subtract. Okay, therefore it will be equal to minus, okay, 3.84 minus the 20. How much is it, by the way? And you just calculate here. Maybe 3.84 billion minus 320,000. Now the reason why I'm subtracting this 320 is because it is taken care of in this 17.92. Is it clear? I hope it's clear. And you get how much with the value? Yes, and don't get this value here. So it's minus 350,000. And you get how much therefore the company's value post acquisition. And you get 17.76 million. I guess 17.76 million to be the company's value post acquisition. Okay. That's the company value. Is it been as per share? I don't know. If they're asking, so if it's per share, then we need to calculate per share. But see, Okay, this is just per share. We see how much it's going to give us. And the question is not very clear whether it's per share or it is a total. So in the way. So therefore, consider for the market price per share of THP post acquisition per share because 17.76 million divided by the number of shares. The 3 million odd shares they had plus 1 million shares that they have issued to acquire CRS company. The THP had 3 million before. Then they issue 1 million. Okay, therefore the combined number of shares is 4 million. To give us how much to be the value per share? 4 point. Give us 4.44. Give us 4.44 to be the market value per share of THP post acquisition. Okay, THP post acquisition. Clear? Okay, hope that's clear. Now, the next thing the question is asking us, okay, what if now this announcement is made public? Don't forget to say that in semi-strong market efficiency, the share price need to reflect the potential value of the project. Okay. Now, this project, where are they investing their money? What is the potential saving they shall be making? Let's go to the question again. The company. Okay, here it is. The earning per share of CRX company is that as a result of acquiring CRX, THP expects to gain an annual tax saving of 96,000. So every year they shall be saving 96,000. So that's his tax savings, okay? That's his annual tax savings per year. Then what's therefore the present value? What's the present value of those savings? Now, this is the new information the market has received. That if the company goes ahead and acquires CRS company, they shall be saving 96,000 per year. What's the present value of that input, that saving? Okay, that's the next video. What's the value of the investment short? Okay, the present value. Okay, the present value of the savings, okay, they should be making once they acquire the company will be 96,000. This is forever, okay? And the present value we discount by R. And don't forget here, the only information you have about the cost of capital is the cost of equity. Which equity is how much? We discount by the discount rate, which is going to be equal to cost of equity. Now this company has a loan. Is it current? This is non-current, so for 8% cost of capital for this company, 8% note. What's the market value? Is there any mention about the market value? Is it considered? So you can get 96,000. So we need to get the present value, which means therefore we need to get the discount rate to the cost of capital, we shall be using in discounting So since we don't know the market value of the notes, what we have is book value. Because in case we had the use that has discount rate. So since we have the note here, okay. So in case we can get the cost of capital of the company, then you can use the company with average cost of capital to discount the 96,000, which you don't have. So what do we do? So since these earnings, actually I think they can use the PE ratio. Since these are annual savings, okay, we can use the PE ratio. Let's use the PE ratio. We get the implied market value of those savings. Okay, that we can do actually. So can use the PE ratio. Okay, let me see what's working here. Market value of the savings. Okay, we don't need this working here. Yeah, so okay, market value savings. Let me adjust here. Market value, we see this actually, which is simply the market value. So let me just call it market value of savings by the use of the PE to earnings ratio. Don't forget the PE to earnings ratio is market price per share or the market value. That's better to use the market value. Market value we divide by the earnings. You want to get the market value will be equal to P ratio, you multiply by the earnings. We have the P ratio, okay, we got what? The P ratio is here, it is, okay, P ratio is at 7.5, 7.5 times the earnings 96, 7.5, okay, and get how much is to the market, the implied market value of those savings. Get 720,000, so get 720,000 to be the implied market value of the sales company. If we had the discount rate, if we had the discounting rate, okay, which you don't have this in this example, then you can also use that we can also use it to get a present value of those savings, okay, the 720,000. You can also use it to get the 720,000, okay. How we done that? Next, to get the company market value, therefore, company market value post acquisition will be equal to the company market value, ignoring the proposed use of the fund, ignoring the savings which you have done in the previous slide. Where is this? Yes, it was here, so here it is. Okay, in this part, okay, we ignore the use of the funds, okay, because this information is yet to be made public. But once this information becomes public, then of course the value of the company will have to incorporate, okay, the potential value of the investment, okay. Therefore, the value of the investment, the company value before the investment, 17.76 million, plus the value of the investment you just calculated, 720,000. Give us how much? What was very clear? If not, ask. Don't forget. I get 18 point. 18.48 million. Okay, we get 18.48 million to the company's value post acquisition, ignoring the use of funds. Ignoring the use of funds. Okay, therefore, the market price per share, the implied MPS, therefore, be equal to 18.48 million. We divide by the number of shares, which is 4 million shares. 3 million plus 1 million give us 4 million shares. You get how much to be the company's market price per share? And get 4.62 and get 4.62. Okay, get 4.62, therefore to be the company, to be the market price per share. Okay, and that's what you are meant to have a discussion on. Okay, you meant to calculate. Okay, don't forget you need to make a comment. Okay, why this is the value. So it should, therefore you need to explain. Okay, that's the company's value. Okay, ignoring the use. Okay, if the information is passed on. Okay, therefore the market price per share, or rather, the value of the investment, since the information is yet to be public. Okay, there's a bit of a discussion. Okay, so in this bit, okay, Roman 1, since the information is yet to be made public, okay, they imply therefore the share price will not be reflecting, okay, the potential value of this, the present value of this investment, okay. If the information is made public, since we are in semi-strong form efficiency, okay, a strong, semi-strong, efficient form of market, it implies therefore the value of the investment will be reflected, okay, the value of investment of the investment will be reflected in the value, under the value of the company, okay. Therefore, the company value will increase by 720, okay, which you have just done here. Okay, so you need to state this, okay, not just calculation, but also stating what you are doing, okay. Question? Okay, so in case there's no question, then I think we can meet on Thursday. Do you have? I hope you don't have. When is the mock? I hope it is not this Thursday.